On the morning of March 10, 2023, thousands of people woke up to a terrifying message on their phones. Their bank was gone. Not struggling, not in trouble. Gone. In less than 48 hours, Silicon Valley Bank, a 40-year-old institution with $209 billion in assets, had completely collapsed. Startup founders were frantically calling their lawyers, venture capitalists were sending emergency emails at 3 a.m., and thousands of employees across hundreds of companies had no idea if they would be able to make payroll that Friday. This is the story of how one of the most trusted banks in Silicon Valley, a bank that had survived the dot-com crash, the 2008 financial crisis, and a global pandemic, destroyed itself in 2 days. And the warning signs? They were there all along. Nobody just wanted to see them. To understand why SVB's collapse was so shocking, you first need to understand what SVB actually was. Founded in 1983, SVB wasn't your typical high street bank. You couldn't walk in and open a checking account. There were no ATMs on every corner. SVB was built for one specific purpose: to serve the tech world. Venture capital firms, private equity funds, and the startups they backed, these were SVB's customers. Over 4 decades, the bank became so deeply embedded in the Silicon Valley ecosystem that it was almost impossible to imagine the tech industry without it. At its peak, SVB was the 16th largest bank in the United States, with clients including some of the biggest names in tech. Nearly half of all U.S. venture-backed startups had their accounts there. But this deep connection to the tech world, it was also SVB's greatest weakness. And in 2022, that weakness was about to be exposed. Here's what happened. Between 2020 and 2021, the tech industry was on fire. Interest rates were near zero. Venture capital money was pouring in. Startups were raising hundreds of millions of dollars seemingly overnight. And all of that money, it was sitting in SVB accounts. The bank's deposits exploded from around $60 billion in 2019 to nearly $190 billion by the end of 2021. SVB had more money than it knew what to do with, so it did what banks do. It invested. And this is where the first cracks began to form. SVB took the billions flooding into its accounts and invested heavily in something that seemed at the time completely safe: long-term U.S. government bonds. Government bonds are considered one of the safest investments in the world. The U.S. government has never defaulted on its debt. SVB's leadership believed they were making a responsible, conservative choice. There was just one problem. When interest rates rise, the value of existing bonds falls. Think of it this way. If you buy a bond paying 1.5% interest and then new bonds start offering 4% interest, who's going to want your old bond? Nobody. So its market value drops. In early 2022, the Federal Reserve began raising interest rates at the fastest pace in 4 decades, an aggressive attempt to bring down inflation that was running at its highest level since the 1980s. Rate after rate after rate, 7 times in 2022 alone. And SVB watched helplessly as the value of its bond portfolio, the investment it had made with its customers' deposits, collapsed in value. By the end of 2022, SVB was sitting on unrealized losses of nearly $17 billion. On paper, the bank was technically still solvent. The losses weren't real yet. They only became real if SVB had to sell the bonds before they matured. And in normal circumstances, maybe SVB could have waited it out. But circumstances were about to become very far from normal. By 2022, the tech boom was over. Rising interest rates had cooled investor appetite. Venture capital funding dried up almost overnight. And startups, no longer able to raise fresh cash, began drawing down their SVB accounts to cover payroll and operating costs. SVB's deposits, which had ballooned to nearly $190 billion, began to shrink, and the bank, now short on cash, faced an impossible choice. On Wednesday, March 8, 2023, SVB made a move that would trigger everything. The bank announced it had sold $21 billion worth of its bond portfolio, locking in a loss of $1.8 billion. At the same time, it announced plans to raise $2.25 billion in new capital to plug the hole. The intention was to reassure investors. Instead, it did the opposite. The message the market heard wasn't, "We're being proactive." The message was, "Something is very wrong." That same evening, Moody's credit rating agency downgraded SVB, and then the phone call started. Prominent venture capitalists, the very people whose startups had built SVB into what it was, began calling their portfolio companies. The message was simple and devastating. Get your money out, now. By Thursday, March 9, 2023, SVB's customers tried to withdraw $42 billion in a single day. That's nearly $500 million every hour. SVB's systems buckled. The share price collapsed by 60% in a single trading session. The capital raise collapsed. No investor wanted to touch it. That night, SVB's cash balance went negative. On the morning of Friday, March 10, 2023, California banking regulators arrived at SVB's headquarters in Santa Clara. They shut the doors. One of the most significant banks in the history of Silicon Valley was gone in less than 48 hours. The collapse of SVB didn't happen in isolation. Within days, Signature Bank, another major lender with heavy exposure to crypto, was also shut down by regulators. Then came First Republic Bank, which collapsed in April 2023 in what became the second largest bank failure in U.S. history, surpassing even SVB. 3 major banks gone in less than 2 months. Markets panicked. Moody's downgraded the entire banking sector. Governments on both sides of the Atlantic scrambled to reassure depositors that their money was safe. On Sunday night, March 12th, the U.S. Treasury, the Federal Reserve, and the FDIC issued a joint statement. All SVB depositors, even those with balances far above the standard $250,000 insurance limit, would be made whole. Every single dollar. It was a dramatic intervention, and it worked. Just barely to stop the panic from spreading further. But here's what made SVB's collapse so maddening. The Federal Reserve's own review, published in April 2023, found that regulators had identified the problems at SVB as early as 2021 and failed to act decisively. The warning signs were there, the risks were documented, and still, the bank was allowed to keep going until it was too late. So what do we actually learn from SVB? On the surface, it looks like a story about bad investments and rising interest rates, but dig deeper and you see something more unsettling. SVB's leadership knew about the bond losses. Regulators knew about the risks. The people whose job it was to prevent exactly this kind of collapse, they had the information, they had the power to act. They just didn't. Because when times are good, nobody wants to be the person who slows things down. Nobody wants to be the one who says, "Wait, this might not end well." And that, more than any bond portfolio or interest rate decision, is the real lesson of Silicon Valley Bank. The greatest financial disasters in history aren't caused by things nobody saw coming. They're caused by things everyone saw, and nobody wanted to stop. SVB was just the beginning of 2023's banking crisis. Within weeks, 2 more major banks would follow, and the story of how they fell is somehow even more dramatic. If you want to see that story, make sure you subscribe, because that video is coming next week. And if you found this breakdown useful, drop a comment below. I'd love to know which financial collapse you want us to cover next. Thanks for watching Financial Collapse. I'll see you in the next one.